Hi everyone, I'm here with the man, the legend itself. The one and only Mr. Jim Schultz is here with us today to talk a little bit about the markets and making some trades. Jim, how you doing today, my friend?
I'm doing really well, man. I appreciate the introduction, and it's a real pleasure to be on with you again. This is now the second time that we've done this, and I'm looking forward to doing many more. And no, man, it's just a good day to be alive. Here on a Wednesday afternoon, and so pretty crazy market that we're in these days, and so I'm excited to talk about it for a little bit.
Yeah. So what are your thoughts on the market, Jim? So the 2022 has been a crazy year, right? Especially
hmm
because we don't know actually about the interest rates and how high will they go, and the fact that we don't know that is not it's pretty unclear. This is bringing a lot of volatility to the markets, especially those growth stocks, right? Those growth stocks here are getting hurt a lot. I have some in my team here, some really experts in valuation to value companies, and they're having a really hard time to value those stocks now because of the interest rates. So how you see those things? How you see the market going, moving on 2022?
Yeah, it's different. It's different now, right? I mean, we're coming off of a 12-year bull market like we've never seen before, and we probably won't ever see before. And so I think that like 2020, especially with the COVID crash and then the rebound, and then 2021, I mean, you had back-to-back years of 30% returns in the S&P 500. That is not normal. Like that is not normal. That is extremely abnormal. That is extremely unusual. And I think a lot of new people to the market, they're like, hey, the market's been going up for 10 years. I've always heard that the market should always go up, which is true, of course. But 30% and 30%, that's way too much. And so when you look at something like 2022, yes, I mean, the story, I mean, you don't have to look very far, and you've got a nice story to fit a narrative of a crashing stock market, right? Rising interest rates, inflationary pressures, supply chain disruption. You've got global uncertainty with wars and pandemics. I mean, pick your headline, right? You've basically got whatever you are searching for when it comes to some story to explain what's going on. But I actually step back from all of that for a second, and I'm like, all right, first of all, we're not crashing. Like, yes, the Nasdaq's down 30%. Don't get me wrong. It is a significant correction. It is, bear market territory. It's all of those things, but it's really far from a crash. It's still very, very far from a crash. I actually view this, Davey, as normal market behavior. I actually view this as the market simply taking a breather from a 12-year bull market run with back to back 30% years. I'm like, hey, man, the market has to breathe a little bit. Like the market has to breathe a little bit and it has to come back a little bit. This is very normal. I'm not really concerned at all. I'm still a perma bull, as I like to say on my show all the time. And we're going to talk about this obviously today, but I think right now is a great time to, build new bullish positions, build on existing bullish positions, begin to play the market to the upside, and all of those things. Of course, we might go lower. Nobody knows where the bottom actually is. But I'll tell you what, if you build new bullish positions right now, you're not buying the high, that's for sure. And so this is a good time, I think, to think about establishing some upside positions.
Yeah. No, agree, Jim. Agree 100%. And that what you say is really interesting. There's a difference between a crash and a bear market. Stocks started to are going down. They're breathing. Interest rates going up. The to pricing the companies with high interest rates, the value of the companies gets lower. This is normal, but that's not a crash. And uncertainty, I think this brings a lot of people get desperate and start selling, saying, oh no, this it's gonna crash, it's gonna never gonna stop going down. So that's when the smart people in the market start really making money because they're buying cheap, right?
hmm That's exactly right. No, that's a really great point. One final thing I want to say, just as kind of some general commentary before we get into some strategies and look at some options and kind of, dive into Tasty Works. Everybody knows, like even people that don't really trade or invest regularly, they know that the secret to the stock market is what? It's buying low and selling high. Now, obviously, as premium sellers, we typically sell high first and hope to buy it back lower later and all that stuff. I understand that. But just to simplify it, right? It's buy low and sell high. Well, I think what a lot of people very quickly forget is buying low is never going to feel right. It's never going to feel good. Like, why do you think we're low? It's not going to be just strawberries and sunshine and unicorns outside and everybody's happy and the market prices are going lower. It doesn't make any sense. So if you
Yeah,
think about the fact, if you think about the reason, or at least one reason, why so many retail traders or investors struggle in the marketplace, it's because they traditionally like to buy high and sell low. And why is that? Well, it's human nature. You're going to buy high when you're feeling good. You're going to buy high when everything looks rosy. When everything doesn't look rosy, when everything doesn't look good, and you've got inflationary pressures and supply chain whatevers and political whatevers and war whatevers, you're not going to want to buy. You're going to want to sell. And in the end, what ends up happening? You end up buying high and selling low, which is the exact opposite of what you're trying to do.
yeah. And finding the bottom, trying to find the exact bottom is a fool's game. It's really hard
Mhm.
to do it. You just gotta play a contrarian move. And then that's funny because when the markets are going up, people always say, "Oh, when the market goes down with 20%, I'm just gonna buy stocks. I'll just sell
Mhm.
puts when volatility goes really high." But when actually does it, people say, "No, no, no! My God, the market's gonna crash. Everything's gonna go down." So yeah, that's a funny thing. So how
No,
are
you're
your
exactly
trades?
right. No, that
Yeah.
that's 100% right. What you just said, it's exactly correct. Yeah, yeah,
Yeah,
that's right.
yeah. Yeah. So how are your trades today, Jim? You have
I don't
anything
know,
you're
man.
looking? You
Yeah,
you
let me
wanna?
pop in here. Let's take a look at my let me take a look at my platform and then we'll get some new. Let me see here if I can do this. There we go.
Yeah, you
All
can
right, so
share your
here's
screens.
my platform. So this is my portfolio that I trade. I'm from theory to practice. So I do this every day at 2 o'clock
Great,
Eastern time.
great.
For people that want to, pop in and check out that show for the first time, that would be really, really amazing.
Let, let, let
You
me
know,
let me just tell to in Portuguese for the people so
oh please.
who doesn't understand here can see what's going on. Aí, pessoal, ele está compartilhando a tela dele aqui na Tasteworks, tá? Então, esses são os trades dele, ó. Estão ali as posições que ele tem em opções. Ele vai montar e começar a conversar aqui, montar uma estratégia, vai mostrar aqui pra gente. Ok, Jim. Good,
Mhm.
good. Let's do it.
Awesome. Okay, so I've only got a few positions on in here. Right now with the market up so much, it's helping my position because I am, long some delta. So you can see the major indexes are higher. It's helping out, my ARKK, my DraftKings, my IWM, my Walmarts, all those kinds of things. But what I really wanted to do was I wanted to give your audience, I wanted to talk specifically about short puts for a couple of minutes. So I wanted to give your audience a couple of things to think about when it comes to setting up a strategically positioned short put. And I actually wanted to, present something that might help out people that are maybe trading with a little bit more capital. So let's say, $50,000, $100,000, maybe multiple six figures, obviously seven figures. Let's talk about maybe a bigger size trade. And then let's also talk about a medium size trade. And then let's talk about a small size trade. So maybe you don't have very much capital, you're just getting started. So I want to show people how they could basically put on a short put strategy in one of the, major indexes in any one of those account sizes. And so let's talk about that. And then Davey, I know you might want to put one of these guys on in
Yeah,
your portfolio. So
yeah,
I'll go give me a few minutes. We'll walk through the analysis and then we'll go over to your portfolio. Does that sound good?
yeah. Right.
Okay, great. Okay, so if we go into IWM, so this is obviously the Russell 2000 index. And so if I go into the trade page here on Tastyworks, and so let's say that I want to look in the July cycle. So I'll try to not move super fast through the numbers here. I'm in July with 51 days to go. And the IV rank in IWM is 70. And this is a metric we use at Tasty Trade all the time to show us kind of where implied volatility is relative to itself. A higher rank, a number closer to 100, means that implied volatility is on the high end relative to where it's been in the last year. A lower number, like, 5, 10, 15, 20, that's going to be a volatility that's on the lower end of its spectrum relative to where it's been in the last year. So IWM, major market index, great product to trade to basically do whatever you want to do. So let me open up July. This is, we've talked about this, David. We've emailed about this, kind of getting ready for the show. I think that people so often they actually dismiss short puts because it's too simple. They
Yeah.
actually feel like they need something more complicated. Would you agree with that?
Yeah, no, 100%. People think to be successful, you have to do those crazy strategies with 10,000 legs or something like that. When the simple just show great results.
That's exactly correct. And nothing gets simpler than the short put. Now, it's simple. That doesn't mean it's easy. It's simple. That doesn't mean there aren't layers beneath the surface that you have to understand. But it's only one leg. There's no multiple legs. There's no spreads. There's no anythings. This is just a short put strategy. And it is a very effective way to play the upside. So if you did want to establish a bullish position right now, or you do have a bullish bias in the overall marketplace, a short put can be a really, really great starting point for you. And I'm only going to scratch the surface here this afternoon on what you can do with a short put, but I want to give your audience a few things to think about. So let's say I'm in IWM and I'm going to target, this is one of the most basic starting points that we like to use at Tasty Trade. I look for about a 30 delta, which gives me about a 70% probability of success. And I'm going to look to sell that put. So I just click on the bid price there. And you can see a couple of things about this trade. So, first of all, again, the probability is about 70%. It's actually a little bit higher than 70%. My probability of making 50% of max profit is higher than that. It's 83%. My credit collected is 457. My delta is positive. That means it's a bullish position. And my theta is positive. And then the last thing I want to mention, and then I'll talk about these metrics a little bit more, the buying power effect on this trade is only $2,500. Now, a couple of things. As I alluded to, this is a bullish trade. It has positive delta. If the market goes higher, this trade is going to work. If the market rises, this trade is going to work really, really well. But the cool thing is, notice that your strike price at 167 is lower than the current stock price at 177. And I know that you know this, Davey, and I know a lot of your audience members probably already know this, but just in case we got some brand new people watching today, that's the secret sauce of selling premium right there. That distance between the strike price and the stock price, you effectively have that as a buffer. You have that as a wiggle room, if you will, where the stock can still go down and you can still be profitable on the trade. So if you have a big account, if you've got $50,000 or more, you know, forking over a buying power of 2,500 bucks, that's only 5% of your account. If you have $50,000, that's only 5% of your account. That's plenty small enough for anyone out there with that type of capital. And obviously, if you have more than that, it's just going to be even smaller. And you can scale up with more than one lot or anything like that, depending on the account size. But this is just a really, really great trade that you can do. And I'll give you three reasons why. It's positive delta, it's positive theta, which you see here on the screen. It's also negative vega, which you don't see here on the screen, but that's okay. If it's positive delta, that means if the market rallies, you're going to make money. It's positive theta, that means as time goes by, you're going to make money. It's negative vega, that means if volatility goes down, if volatility actually contracts, you're going to make money. Now, here's what's really cool about this short put, and I want to get your thoughts on what we've talked about so far. Positive delta, positive theta, negative vega. If you are correct and the market does rally, you're going to make money on all three of those at the same time. Positive delta, positive theta, negative vega. They're all going to work together to potentially make your position very profitable at the exact same time. They're going to work simultaneously. That's a really, really powerful thing, especially in a market that, yes, we're down on the year. And yes, things look kind of, gloom and doom, but the market does want to go higher over time. And so this positions you to take advantage of that. What do you think about that, Davey?
No, I think it's great. I think it's great. One very important thing that you're doing as you are selling an ETF. This is pretty important. So you're already diversifying your portfolio, your trades when you're selling an ETF put, right? So you need to, when the ETFs, something that you said a lot, Jim. That's when the ETFs are with high volatility. You want to go for the ETFs, right? You don't want to look at stocks when you have the opportunity, because the ETFs don't get high implied volatility so often. So when that thing happens, it's a big opportunity you have to do a trade like this. But Jim, if eventually the stock goes down, how down you think that it can go, if I choose to roll that for when 21 days to go, with 21 days to go, I say, oh, okay, I'm gonna roll that for the next cycle. You think how low can this stock go that allow me to roll that for a credit? If you think
So
if it
that's
goes around 160, there's something like that, I still be able to roll for a credit. I think so, right?
So that's a great question. So first of all, you are correct. So when volatility is high, just like it is right now, there's no real reason to trade a lot of individual stocks. Now, of course, it's fun. People like to trade Tesla, they like to trade Amazon. I totally understand that. So, by all means, do a little bit here and there. But your core foundation of your portfolio, there's just no reason not to use the ETFs. It's going to be a smoother ride. You have the diversification, all the things that you already mentioned. So I just wanted to echo that. You are 100% correct. When it comes to rolling, let me erase all this. When it comes to rolling a short put or any undefined risk strategy, so a short strangle, a short straddle, a ratio spread, which we talked about last time I was with you, that was a couple months ago now. The great thing about these strategies is the simple fact that it actually doesn't matter where the stock goes. You will always be able to roll this position forward for a credit. And here's how that works. I'll even show you very simply. When you compare an undefined risk strategy in the current cycle and that same undefined risk strategy in a later cycle, you're always going to find that the later cycle sells for a greater credit. So let me show you exactly what I mean. If we look at the 167, oh, let me grab my marker here. If you look at the 167 put
Uh-huh.
in the July cycle, you can see very clearly that's selling for approximately $4.50, like 455, 456. Okay. I'm going to close up July. Let's look at that same 167 in the next cycle, which of course would be August. So let me go ahead and let me erase those. Let me minimize July. Let's open up August. Let me clear that out actually. Let's open up August. If we look at a 167, notice what you see. It is selling for $6.50. So it's
Yeah.
$2 more than we saw in the July cycle. Now, here's what's cool. That relationship between the current cycle, in this case would be July, and the later cycle, in this case would be August. This relationship will always be true with the later cycle, August, selling for more than the current cycle, July, regardless of where the stock price is. It doesn't matter. It doesn't matter if the stock price is 177 or 170 or 160 or 150. Now, obviously, the actual prices will change and the relationship itself might change a little bit in terms of the magnitude of the difference. But here's what you will always find, and this is what makes naked strategies so powerful. The later cycle will always sell for a greater credit than the near term cycle. And so this is one of the huge benefits. So you will always be able to roll this out for a credit at 21 days to go when your strike gets tested. Whatever you want to do, you're always going to be able to do that for a credit. It's a really powerful thing, man. Really powerful thing.
Yeah, yeah. No, yeah, yeah. That's something that changes a little bit here in Brazil, because the interest rate here are so high that the calls you can always roll for a credit. It doesn't matter how deep in the money they are. But the puts, when they get too deep in the money, even when you're in a naked position, you have to pay to roll because
Wow.
of, yeah, you have to pay to roll because the value of time, and money has value in time. So their rates are so high, you have to pay to roll even naked positions here in puts. So that's the reason why your management tips, when you're doing short puts, the management course you did, I did some videos, I talked to people here about it, and that became so popular because people start, oh, I have to pay to roll my puts, or just gonna sell a call. That's something you do on the
Hmm.
management. They sell a call, and that credit on the call side is way bigger. To sell calls here, you receive a bigger credit than in the US. Puts too, but calls, the difference is really big. People start selling calls and using that credit to offset the debit you have to pay to roll the puts.
Hmm. That's so interesting. Wow, that's really
Yeah,
crazy. That's really,
yeah,
really interesting. I know we might look at the Brazil market here in just a couple of minutes, but okay, that's great. Let's do two more things really quick. So I
right.
gave people an IWM short put if you have a larger account. Let me give people two quick examples. We'll go through these pretty quickly so that anybody who's watching today, big account, medium account, small account, will have some things that they can walk away with. So maybe you don't have 50,000, maybe you've got 20,000 or
Uh-huh,
25,000. Well, here, this is where the X indexes can be really, really useful. Like XLE, XLF, XLU is the one that I'm going to pull up right here. For XLU, this is the utilities index. It's the Spider Utilities Index. And you'll notice that the stock price is only about 70 bucks. So that's really, really nice because what that's going to do is that's going to compress the buying power requirement that's going to be necessary to hold that trade, which is really beneficial when you don't have as much capital. So let me erase that circle. If I go into July, I'm just going to do the same thing. I'm just going to find that 30 put. So in this case, it's about a 31 put. That's right there at the 71 strike, and I could sell that for, it looks like, about a dollar 30 or maybe a dollar 33. So if I click on the bid price, what you're going to notice, now my circles are all messed up, but if I click on the bid price, what you're going to notice is the buying power effect now is only $1,100.
uh-huh.
So my credit collected is a dollar 30, right? Pop's looking good, P50 is looking good, positive delta, positive theta. Again, you have all the same things working for you. Delta, theta, vega, but this is just a smaller trade. So if you only had, let's say, $20,000 in your account, 1,100 bucks, 1,200 bucks, that's 5-6% of your account. Still very doable. Still
Yeah,
definitely small enough for your account size. One more example for everybody out there. Let's go through. Let's say you're like, Jim, I have barely any capital. Barely any capital. Okay. Well, I've got a perfect trade for you. Maybe you're familiar with this index, EWZ.
yeah,
This is the Brazilian index,
yeah.
right? So you guys obviously know this index very well. Well, look what happens. If I go into July and I pull up the same 30 put or 31 put, right? I sell a 32 put for a dollar 40, and I'm going to click on that and look at what happens. My buying power effect is only $450. So now all of a sudden, if I only have $10,000 or even $9,000, even $8,000, right? This type of position size could absolutely work. Now, one final comment I want to make, and then I'll turn it over to you. We can put on any one of these trades. We can look at the Brazilian market. We can do whatever you want to do. The final comment that I want to make, just to be very complete and very clear with everybody, because one of the things I say on my show all the time is for every gimme, there's a gotcha. And so we talked about the benefits of a short put. We talked about the positive delta. We talked about the positive theta. We talked about the negative vega. And we talked about when the market rallies, all three of those things are going to be working for you. Okay, that's great. What happens, Jim, if the market doesn't rally? What happens if the market goes down like it has, for the first 5 months of this year? Well, all three of those things, not positive theta, because that's always going to be working for you, but delta and vega, they're both going to work against you. So you have to be ready. And this is why the size of your position is so important. You can't get too large. You have to be ready to sit through some storms if that's what comes your way, because it's going to come your way, at one time or another. And so just be aware that when you sell puts, if the market does go down quickly or it goes down hard or it goes down a lot, you are potentially going to have to, absorb some pain on that position. So I just wanted to make sure everybody was clear of what the gotcha was with this position.
Yeah, great, Jen, great. I'm just gonna translate to people a little bit what you just did. Ó, pessoal, ele fez três trades aqui. Ele mostrou que se você tiver menos capital, você opera uma, uma ação que tem com um valor absoluto. Os três foram ETF, né? O ETF que tem um valor absoluto menor. Então ele operou aí o EWZ, que foi esse último aí, ó, EWZ, que é mais barato. Então você tem menos, tem US$ 10.000, por exemplo, de capital. Você vai operar isso aí, você vai usar um pouco menos de margem para operar, entendeu? Great, Jim. Great.
Mhm.
Fantastic. I
That's
just love
great.
it.
So why don't
Yeah.
we here? I'll stop sharing my screen.
Mhm.
Why don't we flip on over to yours?
All right.
And then we can do whatever you want to do. You can put on one of these trades. You can show me the Brazilian market, whatever you want to do.
All right. Just and, I'll just all right. Here's my so you can see my screen, right?
Hmm.
Yep. So here it is. Let's do the Russell. I don't have. This is a demonstration account. I don't have much buying power, but we can do the Russell. So
Let's
we
do it, man. So yeah. So what do you think about a 30 put? Like when you sell puts, Davey. Like, talk to me about your process there. Like, what do you typically look for?
well, the thing is that in the we have a team that values companies. We do a lot of fundamental analysis. So it's a little bit different because on the fund we have a team that do a lot of fundamental analysis. We sell puts on stocks that are we consider really cheap here, right?
Hmm.
So the first thing is we say, oh, this is a cheap underlying. So in the fundamental analysis, we look at if the company is generating cash flow constantly, if it's paying dividends, margins, debt, all these kind of things. So you get a little bit more secure to selling puts in these situations because it's much easier to roll until you're right, you know, because even the market goes down, this has a bottom because the company is generating revenue is growing, all this kind of thing. So we this is the first thing, and the second thing is volatility. We look for high implied volatility. I like to do naked positions like you because of the management that you can do. If you do a spread, a credit spread, once it all gets underwater, it gets all in the money. You have difficulty to roll. You have to pay to roll. So the management opportunity that the naked position gives you, I think it's the is a differential. It's something that makes those naked positions so powerful. So that's pretty much the what we do. We look for the stock. We value the stock, and then we look for high implied volatility to do this. You always selling premium here. We like to sell premium.
Hmm.
I like to sell premium myself. Once you got, I guess the big difficult people had when talking about selling premium is because they get a little nervous when the trade goes against you. They keep looking at the swings on your P&L. Once you keep practicing, you get more you keep doing, you get more experience, then things get so much easier. And even if the trade goes against you, you will find a way to escape, to roll, and to do something else, to swap for a different underlying and this kind of things, you know.
Hmm. Hmm. Yeah, no, that sounds really, really good. Yeah, no, that makes perfect sense. So when you go in for a short put, are you around like a 30 delta? Like, how do you decide what delta to choose?
Yeah, that's a big question, Jim. Uh, it depends on the stock. Some stocks I think are really cheap. I go much closer to the 30 delta, 25, 20 delta, something like that. And when I don't know what's gonna happen, and I don't really know that company so well, I might go to the 16, the one standard
Hmm.
deviation, the 16 delta to sell. And the thing here in Brazil, the premium, the stocks are cheaper. You know, see,
Hmm.
IWM here is traded for $176. Here we don't have any stock that trades for 176 reais. That is the
Hmm.
currency here. We don't have that. All the stocks here trade for 20, 30. I don't know, 50. The most expensive one is the ETF, that is the BOVA, the ETF. Here's like SPY, the Brazilian version of SPY, that
Hmm.
trades now is trading now for 104, 105, I think. So
Hmm.
this is the so you don't have see you have to sell a bigger amount of options to get a decent credit. You know? So that's something that's different too. So
Okay.
that depends.
Yeah, that makes sense. That makes sense.
Yeah.
Okay.
So we're looking at the July, right, Jim? The
Hmm.
July here, 51 days to expiration. This is the closest to 45 days. You don't have as much gamma risk as you do if you're gonna sell the June, right?
That's right.
So the 167 put here, I'm just gonna go short put, right? So just gonna put the strikes here, the 167, two, 535 dollars. All right, to $2.5 thousand here on buying power.
Hmm.
I'm just gonna throw this trade here, Jim. Just gonna do one contract here.
I
It's
like it.
filled.
Filled,
All
filled,
right.
and he actually got improved. So there you go. Yeah.
Yeah. That's great. That's great. So pretty and if you guys are watching, Jim is throwing trades every day at the Frontier to Practice on the Tasty Trade platform on the
Hmm.
website, right, Jim? That's it.
That's right. Every day at 2 o'clock. Yep, that's right.
Every day. Então todo dia às 2 da tarde, pessoal. Se vocês quiserem ver ele lá montando estratégia, fazendo trade, ele tá por lá. Now you let's look at the Django here, Jim. Let's take a look at the Brazilian market. What do you think?
Let's do it. I'm ready, man. I'm ready to learn. Let's do it.
This let me. So here in Brazil, we don't have a platform like Tastyworks. There's nothing like that. Here what we have, this is an OpLab. It's a website where you can look at the all the options. I'll put it like this. This is strategic vision. So here you can see the strikes here in the middle
Hmm.
and puts in the right, calls on the left. And here are 16 days to expiration, 36 here. We people don't have any platform that shows on days the days running days. They only have trading days. So 36 open days with the market open. So there will be the equivalent to do 51 days
Got
your
it.
trades. So the expiration is pretty much in the same day, the third Friday of the month. So what we do here, we look at this is the market monitor. Here we have a list of stocks. We look for volume here. So pretty much the top 90 stocks here, when you look at volume, there will be some stocks we can trade. Here we can decide how to trade. This you can see IV rank, and IV percentile for the stocks. In Brazil, we have a lot of this is it's focused on commodities. The biggest companies here are commodities companies. So we have here number one, Petrobras. This is a company that for it's an oil company for fuel. This is Vale. Vale's for iron ore. They export to China iron ore.
Hmm.
Now here's some banks. We don't have anything like big tech companies, disruptive things. It's just some small companies. This is banks, commodities, energy is pretty different here. The market. So for this, some stocks here they don't move so much. Here we have, for example, BBIS. This is a bank. It's a state bank. This is a bank that's ruled by the government. So this changes has low volatility. If you have an option to trade did this with in a high volatility. That doesn't happen very often. So it's pretty easy because the moves are pretty. They're not so random. Doesn't move that much. So here's where we choose which company to trade. You see Petrobras with a IV rank of 20, IV percentile 56. We have Vale here with IV 35, IV rank 47, IV percentile 41. If you're gonna look for high IV rank, the highest IV rank here, we have some companies here, but these are companies that are going to maybe even go bankrupt. We have, yeah, they might go bankrupt pretty soon. What we have here is we have the ETF, that is Bova. We also have an ETF here now trading with IV rank 37.98. What do you think, Jim?
Yeah, that's not too bad, and you don't have to worry so much about the company going bankrupt, and so that's obviously one of the big benefits of using ETFs. Yeah, I mean let's open it up. Let's take a look.
So here where we can see can you see there, or is it too small?
No, I can see it.
So here are the puts, and we have the calls here on the right side. I'll go for this July expiration here. And this is trading now for 106 reais. Here we have the delta for the puts. The 29 delta put, we have the 103. 103 is the 29 delta put. See,
Hmm.
it's not a big move, right? For
No,
106
no.
to 103. It doesn't have to move that much to go so you can reach the 30 delta. 29
Yeah,
delta actually.
yeah.
We can sell that. Let me do it like this. Oh, here's the 103. Yeah, the 103 delta put. This is the one we can sell. This is different, man. For the you can see all the Greeks here.
Hmm.
I can do. The thing is, Jim, here we just look at the options. We cannot actually trade through this platform.
Hmm.
There's not a platform like Tastyworks here, so you can where you can see the delta and trade. This is pretty
Hmm.
difficult here to trade here, man.
Hmm.
It's a different environment. A whole is way harder to trade here. So
Hmm.
you look here, you find the options you want to trade, and then you go to your home broker or your robot, your platform, and you do the trade there. So here is
Oh,
where we can actually just look at the options.
I see. I see. Yeah. I mean, it's a pretty good. I mean, it's honestly not too bad. I mean, no, it's not Tastyworks, but you have a lot of information on there and it gives you a lot of, I mean, IV rank, you don't see that everywhere. So that's pretty good. And so it's really not bad from an analysis standpoint. And yeah, but obviously it's a little clunky and cumbersome to have to then go to your broker and do the trade there and all those things. But that's interesting. Yeah.
Yeah, yeah. So you don't have many underlines you can trade here. That's
Hmm.
the biggest difference. Here what's happening today is 2002. The Brazilian market is actually going up because of inflation, commodities inflation. So the market
Hmm.
we're outperforming the S&Ps this year. That doesn't happen pretty often.
Hmm.
Actually, the S&P used to outperform Brazilian market, but not this year. So the volatility is not high now. The volatility is low here now because the market is going up this year.
Hmm.
These
That's
companies,
interesting.
yeah, these oil companies, banks, and iron ore, because of the inflation, they're making a lot of money. So 2002 has been a great year to invest in Brazil, actually.
That's good. That's great.
Yeah,
Yeah.
yeah. So yeah, it's hard to find some puts to sell here. So it's easier to sell puts in the U.S. now.
Yeah, sure. Sure, sure.
So let's see if people have some questions here. Jim? What you think?
Sure. Yeah, if you got a couple questions, I got time for a couple questions. Yeah, let's do it.
Ô, se alguém tem alguma pergunta aí, você quiser fazer pro Jim, gente, pode colocar aqui no chat, tá? Vamos dar uma olhada aqui. Here is John Guilherme here is asking Jim if you rather just to sell the puts than do the strangles and go more delta neutral. What do you think about that?
Yeah, this is the classic question that I'm asked on a pretty regular basis. And so first of all, let me say that whichever one you do, a short put or a short strangle, great strategy. So if you want to be a little bit more delta neutral, if you want to be a little bit less directional, if you want to sell both sides of the market, absolutely a short strangle is a great strategy. Because I'm more bullish just by nature, I tend to gravitate more towards short puts. Now, of course, every gimme has a gotcha. I mean, all your short puts since January in the US market have been getting absolutely crushed, right? And so short strangles are getting crushed. They're just getting crushed less because you have a little bit of premium coming in from the call side. But, for the last 11 years, short strangles were kind of a difficult trade at times because that call side just kept getting pressured day in and day out. And so it kind of goes both ways. My feeling right now, I would much prefer a short put over a short strangle, even more so than I normally do, because I don't want to have that short call out there just in case, we get our face ripped off to the upside. I don't really want to have to battle an in the money short call. Now, if I could go back in time and it's January again, then of course the short strangle is the better play. Well, I mean, if I could go back in time, short delta is the best play that you could do. But of
Yeah.
course, not being able to do that, a short strangle would be the best move relative to a short put. But I tend to be more towards a short put. But a short strangle is a great strategy.
Okay, great. So we have Leandro here. This is a big fan of your videos, Jim. He's watching your videos and saying your crash course. You recommend to use the delta to theta relations 1-2, saying he's been using 1-to-1 in doing well. What do you think about that? Why you do the 1-2 delta to theta relation?
Yeah, so thank you so much for watching the crash course. I really appreciate that so much. It really means the world to me that any of you guys invest in my content. Thank you. So 1-to-1 is not too bad. So honestly, 1-to-1 is not too bad. You're not way off the mark. If you've kind of found a level that you're comfortable with, then by all means, I would stick with that level. If you're 1-to-2, it just makes you a little bit less directional, especially if you have a bearish bias. I have found that the delta to theta ratio is not as effective if you have positive delta, because the idea behind the delta theta ratio is for you to protect your short premium with short delta. So that's what it's really trying to capture. Now, a lot of tasty traders and a lot of the hosts on the network and the traders on the network are short delta by nature. And so that ratio makes a lot of sense for what they're doing. For me, being longer delta, I typically don't use the delta to theta ratio too often. I just look at delta independently. I look at theta independently. And so 1-to-1, I have no problems with that ratio whatsoever. I say if you found a level that you're comfortable with, just understand you are more directional per unit of theta than you would be with a 1-to-2 ratio. And so if you like the way it sets up, if you're comfortable with the risk, I say keep going with it. If you feel like, I kind of want to give myself more protection for whatever reason, especially if those deltas happen to be short, I would just bump up that theta number a little bit more or trim your directional exposure.
All right, great. One more, Jim. Just one more, okay? Let's
Mhm.
do it here. Luis asking about the Jade Lizard. He chose Jade Lizard and Big Lizard. He likes better than the short puts. What do you think about those strategies?
Yeah, I really don't mind. I don't mind those strategies either, especially like a jade lizard. A big lizard. I mean, it's a straddle, and you're kind of buying that upside call. I don't have any problem with that really at all. When you do a jade lizard, as opposed to a short put, you're selling the put on the bottom, and then you're selling the call spread on the top, and you have no risk to the upside. The only thing I don't love about a jade lizard, it's the same reason that I don't generally love short strangles relative to short puts. Again, it's a great strategy. It's a very effective strategy. It resonates with a lot of people. I don't want to put myself in a position as a naturally bullish trader. I don't want to put myself in a position to where my upside risk is hampered in any way, shape, or form. So with a jade lizard, like let's say you do a $2 wide jade lizard. I mean, the short put is just a short put, and then you sell the call spread for whatever you sell a $2 call spread for whatever you sell it for, and your total credit collected, let's say, is 225. Let's say. So you have 225 in total credits. You have a $2 wide call spread to the top side. If the stock stays between your short strikes, then that's great. You're going to make all the money that you want to make. But if the market rips higher and that call spread goes in the money, you've basically given up all of your profit potential. Now, again, by selling the call spread, you have more buffer to the downside. So there is obviously a benefit to doing this. I really don't like that trade off, just generally speaking. But some traders like to be more neutral. They don't want to play the upside. They don't want to be as dependent on the market moving higher. I totally respect that. I totally respect that. I understand that. And so a Jade Lizard can be a really good strategy. It just doesn't really work for me for the reasons that I just mentioned.
Great, great. Perfect, Jim. So that's it. I'll let you have lunch now.
Thank you.
Yeah. So everybody, you can watch Jim. You can follow Jim on social media, on Twitter, on Instagram. And watch Jim at tastytrade.com. Here on the course there, you can find Jim's classes. He's just a fantastic teacher and a fantastic trader too. And
I don't know about that.
uh, I hope we can catch up again sometime, Jim, to do some more live content. And thanks everybody. Obrigado aí pessoal que está aqui assistindo. Thanks for tuning in. And have a great afternoon, great day for you, Jim.
Okay. All right. Bye, guys. Thanks, Davey.
Thanks a lot. Bye bye.